Welcome back, everyone. This is part 3 of my Tesla 4Q 2024 estimates deep dive. So we continue on with the important service and other segment. Here you can see the forecasted revenue evolution, and you can see I expect a 2% sequential growth in a quite material 32% sequential growth. This segment I forecast to hit for the first time 11 billion in revenue, so quite material. And keep in mind this is even slightly larger than the energy revenue. However, the margin is much lower. 2023 was 8 billion, 2022 was 6 billion. So this grew 60%, 37%, 27%. Still very healthy growth rates. The primary driver. So what you have done, so first of all, what's included in service and other, and I listed all the items here. So a big driver is of course sales of used vehicles. So for example, the lease return vehicles we talked about earlier. And also a very important part is the any type of service Tesla provides to the fleet that is not under warranty. So the not warranty after sales services is a very important part. Also increasingly any bodywork after collisions, etc., and associated part sales is an important part. Important to note is Tesla is right now not fully exploiting that important element, because in many countries Tesla's bodywork is entirely provided by other parties, so certified, for example, dealerships often provide, or also some other types of repair shops or chains of repair shops. So this is an opportunity Tesla can expand. Then also paid supercharging is included in this item. The vehicle insurance business is included in this line item, and then also retail merchandise. So overall, what's interesting about this revenue item is that it has never seen a sequential decline, has always grown quite healthily, and this is simply a function of the growing scale of the growing fleet size of Tesla. Both the warranted and the non-warranted fleet contribute to this revenue line and all these other line items. So there's a very strong fundamental scale effect that is pushing this revenue line quarter by quarter. By the way, here is a line. This means this is not a typo. It was actually the same number in both quarters, but again, it didn't sequentially decline. So this is interesting. It's not the key item or not the story of 2025, because it's simply not high enough margin relative to energy. That's the only reason. And energy is forecast to grow much faster than this. So with that out of the way, let's look a bit at sort of the vehicle fleet, which is kind of providing a big quite predictable driver of this revenue item. You see here approximation of the total fleet split into under warranty and out of warranty. And this might look to maybe many people quite counterintuitive. You see the vast majority of the fleet is actually still under warranty, and out of warranty, where basically customer has to pay for all the parts, etc., is very, very small. And the reason is, first of all, Tesla's relatively generous, or pretty much in line with industry standards warranty, and so which is quite long, and also the very fast vehicle growth. You can see the annual sales. So 1.8 million this year, also pretty much same number last year, 1.3 in 2022, yada yada yada. So you see so the annual sales, and this is the cumulative fleet, and then you can see how the cumulative fleet grows year over year. And because if we just look at this number here, so 2021, as of December, the global fleet was only 2.3 million. In the subsequent year, the fleet grew by 1.3 million. So it was a 56% growth rate, and it grew to 3.7 million. And then because the sales in 2022 were so large, 1.8 million, it grew by yet another 50%, so to 5.5 million. And then you had another almost 1.8 million, and it grew to 7.2 million. And because again, the warranty is quite long. People can drive quite a few miles before they run out of warranty, and for many parts, you have more than 4 years of warranty. So there is quite significant delay before vehicles leave entirely the warranty period. So we can see. So if you just imagine this dark blue part grows into this lighter blue part, you can see there's significant potential. I just wanted to make this transparent on this slide because I think it's still vastly underrated what a meaningful driver this gets. And because of the fast growth, this piece will start to accelerate in growth. So this is very interesting. As I said before, there's still untouched potential in providing more body repairs in-house by Tesla and various other things. For example, part sales by OEMs tend to be the most lucrative part of the auto business, and some automakers. Some of the established automakers with very large out of warranty fleets, they make a significant share of their profits just from part sale because margins can be, many parts are sold at margins that almost rival software margins. So now we arrive at sort of an intermediate key financial metric, which is the total revenue line. I expect sequential growth of just under 6% and almost 6% year on year. The key driver is the energies business, adding up $1 billion in revenue, as we discussed earlier. Service and other line adds a bit of revenue, keeps growing steadily. The auto business year on year is sort of the weak spot. 2022 4Q auto revenue was 21.6 billion, has come down 20.3 billion. The primary driver was the significant reduction in average selling prices, and of course there was a small volume effect associated with that. Before we move on to gross profit, I wanted to discuss real quick FX or foreign currency effects affecting Tesla. Tesla obviously reports in US dollar, but Tesla has very significant exposure to various foreign currencies, and this includes especially the Chinese yuan. Also, the euro is an important currency to Tesla, also the British pound, and even Norwegian krona, because China, obviously, because of the large sales volume, also in the euro area, Tesla sells a lot of vehicles, and then also the krona. It's a very small country, relatively small sales on a global scale, but still an item that Tesla discloses as one of their key FX exposures. And so what I did is I built an FX impact model on revenue. I'm using disclosure by Tesla. I'm using trends in FX relative to the US dollar. Obviously, this model back tested, was spot on for every quarter. I'm using estimated revenue generation per currency for this model, and so I predicted all these moves correctly before. These are items Tesla disclosed, but Tesla recently stopped disclosing these items because it became, here it was very material in 2022, especially 2023 we saw some easing of currency pressure, and then 2023 sorry, in 2024 was also less, and then in 3Q Tesla had a slight positive, and then this is my estimate, and for 4Q I estimate a tiny positive impact, and for this reason Tesla will, I expect, not disclose this item. Tesla also didn't disclose this item in 3Q because again it became kind of a non-needle mover. Last time Tesla disclosed it was in 2Q. So, and you can basically check me if in 3 weeks Tesla discloses this item, and it's a number that deviates meaningfully from this number. You can prove me wrong, but I expect Tesla will yet again not show this item because it has become non-needle mover. So the reason why I spend so much time on this, what looks like an irrelevant item, is one, to have a more accurate view on how international sales could affect Tesla's USD reported sales, number one. But then there is another very important factor we touch on later, which actually in this quarter is a very important item. But I will not tell you the secret now. You have to watch the video. Not just kidding. I'm not the type of person. So the reason why this is important is actually later in after the operating profit line, there's an item called other income or expenses, and here is where Tesla books the effect from currency changes on intercompany balances held in foreign currency, and this had a very quite substantial negative impact in 3Q. And by analyzing global FX exposure, I can actually more accurately predict what this other item will be in 4Q. This is so in 4Q. This is the primary purpose why I run this exercise, because this is a quite involved calculation. It's like its entire model by itself with several hundred lines. But we get to this a little later. So on this slide, you see the total gross profit, and we dive into sort of the key drivers in a second. You see this is +0. So +0 means this doesn't round to a full positive, but it is a positive, and you can see the absolute numbers here, which I show for this purpose in million. So I forecast a tiny, basically 0.1% increase sequentially, and I do not forecast total gross profit. It's just the result of the modeling, and you will see the components in a second and why this happened. But I can already tell you this of the big driver, which is obviously the average selling price came down so much by leasing, financing rates, discounts, other incentives. So then when we look at the drivers of gross profits, again, it's like the exact same slide as before. And you can here see the primary drivers. So auto gross profit came down. Again, the main driver is average selling price. Auto gross profit came down despite higher sales volume, because the ASP decline was just too much to compensate just via volume. The upside came from energy and storage, which grew quite significantly in relative terms from 0.7 billion to 1 billion. And then the service and other, because it's a lower margin revenue line, Elon said once he kind of wants to keep it around about break even, because he doesn't want to, overcharge customers for having their Teslas maintained. And then you have, and here you have sort of the splits. I also break out here FSD subscription revenue. This number is much lower than I think what is intuitively assumed, because it simply has to do with the numbers. So the reason why FSD subscription is not that big is, first of all, it's geographically limited. Geographically limited means it's only applicable to where you can actually subscribe to FSD right now, which is only, in quotes, North America. Tesla charges you $99 per month, so basically this is $300 a quarter, because we were looking at this stuff in quarters, right? And you do not have 100% penetration, and also the North America Tesla fleet is not the entire fleet. It's not all Teslas can, although it is a smaller factor, can actually receive FSD. Then you have the issue that some people have hardware 4, some people have hardware 3. So when you basically take all these factors into consideration, and then if you think about this in terms of incremental growth quarter on quarter, let's say you have an increase of take rate by 5% in a quarter, which would be quite significant. You cannot assume like the 5% is from day one of the quarter throughout the entire quarter, i.e. it's like $300 per person, what that 5% means. No, it would grow throughout the quarter, right? And therefore you have to assume averages. So when you take all these little mathematical things into account, even if you assume a significant boost on take rate, which appears reasonable, Elon talked about this. Elon commented on a significant increase in take rate after the Cybercab event. It's still not a needle mover. So just keep this in mind, keep your expectations low. I expect subscriptions to be a largely a medium item for probably quite some time, because subscriptions is long-term always only sort of an intermediary step to, because keep in mind the business keeps growing, and many other things will be growing very quickly. So this very small line item has to grow incredibly quickly to ever catch up to become a needle mover. So keep this in mind. But having said that, what makes this different is that this is basically, you could say, almost pure profit, because it's part of the entire FSD product line, which also includes the Cybercab. which also then later will include the ride-hailing revenue from vehicles that Tesla owners contribute to a ride-hailing network, where Tesla takes a cut of the revenue, etc. But right now, this is not a key needle mover. Just keep this in mind. So then, when we look at this, what does this entail in terms of average vehicle gross profit if we include the effects of leasing, the effects of credit revenue, credit sales. So the net result is, and again, I'm not forecasting this. This is the outcome of all the things we discussed previously. If you just run it through the accounting, and the net result would be a quite significant drop in average vehicle profitability. I expect almost 14% decrease sequentially, and over 10% decrease year on year. The reason why we saw such a significant increase in 3Q was that um, there was a significant one-time item, which was the um, Cybertruck FSD release, plus the ASS, the actual Smart Summon FSD feature release. Both together added over 300 million in basically almost pure profit, and this makes a significant impact to gross profit. Then on top of this, the IRA, so the benefits electric vehicle makers receive from the, the funnily named Inflation Reduction Act, also probably made a significant impact. And when you, for example, study General Motors disclosure, they also talk about this on their investor day, etc. This actually allows General Motors to bring down their kilowatt price on a pack basis so much. I just would recommend everyone to review the disclosure. It's quite interesting. And then, so basically here, I list some of the key items. So the credit sales, I mentioned they increased a little bit sequentially. I expect the Cybertruck gross margin to increase sequentially. It's also helpful because it was quite low in 3Q. It just became for the first time gross margin profit positive, according to the CFO. Then the IRA impact we just discussed. Also, the increase in FSD take rate will have a positive impact on the margin, because there's one, the subscription revenue, which helps the margin. But again, as I said before, this is not a huge driver, but there will also be some number of people that will buy FSD outright. So that has obviously a much more significant impact. But then you have to keep in mind that Tesla puts part of that significant increase in purchase price aside in deferred revenue, which actually is being taken out then from this line item, so that there are various factors then also account for the significant ramp in 4680 production, and this benefit compounds with the IRA credits that's the producers, the OEMs receive for making batteries in America. And then also just on higher volume, there is a higher degree of fixed cost absorption, because even in COGS, there is fixed cost. I give you just one example. For example, Tesla uses depreciation of their equipment, factory tooling, etc., on a straight line basis. So that means they depreciate equipment not based on how much volume they put out, but on just on age. And for that, Tesla assumes a useful life of equipment, etc., and includes a fixed amount of depreciation each quarter. And of course, if you have more volume, you can spread this fixed charge across more units, and that would be reflected in COGS. So this brings us to the TVS, but this is something I will cover in part 4, since this part 3, has already become quite long. So see you in part 4. Bye.